I invested $50 million in Apple and Amazon 9 years ago, and that investment grew to $500 million, essentially a tenfold return. I don't see it as something extraordinary. All I did was purchase these digital networks when most people doubted them, recognizing their potential. And then I waited. I promised myself that if I ever identified a similar opportunity, I wouldn't just invest personally, but also commit my company to it. Many who experienced Bitcoin's first decade were left scarred by its extreme volatility. However, those perceptions are outdated because the system has evolved significantly. Institutional investors have entered the space, and since March 2020, it has become a distinct asset class. If you analyze the trend since then, the pattern is clear. It rises 50%, corrects by 25%, then climbs another 50%, retraces 20%, increases by 60%, and again pulls back 25 to 30%. Essentially, it's following a consistent growth trajectory. I explain it like this. If you examined LeBron James from age 9 to 18, he showed raw talent, but was unpredictable. But if you assumed his volatility would continue into his prime, you'd be mistaken. From ages 18 to 28, LeBron became the greatest athlete in his sport. His volatility manifesting in dominance rather than inconsistency. In a basketball game, LeBron's dynamic actions are the driving force, whereas a static object like a rock would offer no volatility at all. Volatility doesn't concern me much. While there will be rapid growth and pullbacks, institutions are stabilizing it. The capital involved now isn't from over-leveraged consumers or day traders, but from insurance companies and major corporations planning to hold long-term. If asked when I'll sell, my answer is never. My intent is to hold indefinitely. The market has shifted to long-term institutional investors with substantial resources, signifying a mature asset class. Given the scale, a $1 trillion asset has more inertia than a $100 billion one. I foresee Bitcoin expanding aggressively to challenge gold, eventually surpassing and absorbing it. Initially, Bitcoin will reach $10 trillion, as gold stands at that level. Later, Bitcoin might grow to $20 trillion, while gold shrinks to $5 trillion, or even $4 trillion, relegating gold to a decorative role. Bitcoin is also poised to attract monetary value from negative-yielding bonds. A recent Twitter poll I conducted with 65,000 responses revealed where the capital for Bitcoin originates. 49% from stocks, 20% from gold, 10% from bonds, and 19% from real estate. As monetary expansion accelerates, even value stocks are likely to yield negatively, making Bitcoin an increasingly attractive asset. Everyone understands that bonds are essentially worthless now. Ray Dalio has pointed out that they yield negative returns, specifically when compared to the Consumer Price Index, CPI. However, the more significant issue is that bonds are generating negative yields relative to the cost of capital or the rate at which the monetary supply is expanding, which ranges between 15% and 25% annually. They are clear destroyers of value. For this reason, I believe Bitcoin will reach $10 trillion as quickly as possible and then continue to grow by 50% to 60% annually, eventually reaching $100 trillion. As it expands, this growth will gradually slow down, moving from 200% to 150%, then 100%, 80%, 60%, and finally 40%. This pattern mirrors the growth trajectories of companies like Google and Amazon, which have consistently grown at 20% annually despite their massive valuations over the past 5 years. Once Bitcoin reaches such a scale, its growth rate will likely stabilize at around 20% annually, ultimately capturing the entire market for treasury assets. At that point, growth will align with an organic rate of 5% to 7%, reflecting a reasonable cost of capital. One of the most critical factors to consider is estimating the annual rate of monetary supply expansion over the next 8 years. If you believe this rate will decline from 15% to 10%, then to 5%, 2%, and eventually 0, a traditional investment portfolio might seem reasonable. However, if you expect monetary supply expansion to remain steady at 15%, scarce assets become a necessity. Ultimately, bonds and real estate do not function well as stores of value during monetary inflation. Bonds offer fixed coupons, while real estate returns are typically tied to or capped by CPI. In such an environment, the best options are either equities with growth potential or scarce assets. If monetary supply expands at 15% per year, you need an equity portfolio capable of growing by at least 15% annually to maintain value. Alternatively, investing in trophy assets, such as a beachfront home you plan to keep for life, can be worthwhile, since it will always hold personal value, especially when leveraged. Scarce, digital assets like Bitcoin are another strong option. The key is to invest in assets that wealthy individuals will still want to buy a decade from now. For example, New York municipal bonds offering a 2% yield today will likely deliver a negative real return of 15% in the future. Therefore, focus on trophies, equities, and scarce assets. In my opinion, Bitcoin stands out as the best property available. Determine your risk tolerance, allocate an appropriate amount to Bitcoin, and diversify the rest into assets you understand and trust. Bitcoin is the ultimate treasury asset, significantly larger and less risky than any alternative. Its potential market size is 100 times greater than its current valuation. In contrast, everything else in the crypto space resembles venture capital. While investing in crypto ventures can be lucrative, these assets are far more complex and have a substantially smaller potential market. If your strategy is to invest in digital gold and hold it, Bitcoin offers a superior version of gold, supported by advanced technology. The approach is simple: acquire it and wait. We're not irrational. The key point is that Bitcoin is the world's first digital treasury asset. There are $100 trillion worth of treasury assets in the form of negative yielding or zero yielding debt and cash, effectively generating a real yield of negative 15%. The bond market is failing, and traditional treasury strategies no longer work. Bitcoin provides a solution to the 400 trillion problem faced by investors. This issue affects everyone, 7.8 billion people worldwide, who earn salaries and hold cash that devalues by 15% annually. Bitcoin represents the most disruptive technological advancement of our lifetime. Years ago, I discussed Apple and Amazon, and I invested $50 million in those companies 9 years ago, turning it into $500 million, a tenfold return. It wasn't difficult. I simply recognized the power of digital networks when most people were skeptical, and I held on. I promised that if I ever encountered another opportunity of that magnitude, I wouldn't just invest personally, but commit my company to it. In 2020, we faced the greatest financial crisis of our careers. With $500 million in capital, I identified a digital network that I believe is 100 times better than Google or Facebook. A financial network akin to Facebook, but for money. Unlike social platforms, where a billionaire's presence doesn't significantly boost revenue, Bitcoin benefits directly. When a billionaire enters the Bitcoin market, they can purchase $1 billion worth, turning Bitcoin into a self-sustaining, cyber-based bank. Recognizing this potential, we invested, and the strategy has proven effective. Institutions are now confronting the same problems, and many are adopting Bitcoin, driving its price from $40,000 to $60,000 within a year. I believe this represents the most significant opportunity of our era. To put it in perspective, if someone had asked Jeff Bezos in 2003 whether he regretted not selling Amazon after its 80% decline, the notion would seem absurd. While Bezos could have sold in 2000 to avoid a 95% loss, doing so would have cost him his place among the world's richest people. The same applies to Mark Zuckerberg, who could have sold Facebook shortly after its IPO to avoid a 50% drop. Bezos faced 5 major downturns, where he could have exited Amazon and avoided losses of 80%. Yet holding on made him one of the wealthiest individuals alive. Attempting to time the market is a trader's mindset. But the richest individuals, Bill Gates, Steve Ballmer, Jeff Bezos, Elon Musk, Mark Zuckerberg, Larry Page, achieved their status by holding, not trading. None of them became successful by constantly timing their exits. Trying to time the market is impractical. Statistical analysis of assets like Bitcoin or the S&P 500 shows that around 80% of returns come from just 1% of trading days. Missing the 3 best days in a year could mean losing 80% of potential returns, and missing the top 6 days could erase your gains entirely. The reality is that for 98% of the time, it may feel like you're not making substantial profits, but then suddenly you might wake up to news that a sovereign wealth fund from a Middle Eastern nation has invested $10 billion in Bitcoin, causing its price to double or triple. At that moment, you may regret not having bought at a lower price and feel frustrated. The trading mindset often leads to poor outcomes for most people. Unless you're running high-speed trading algorithms capable of making fractional gains millions of times an hour, trading offers no real advantage. The vast majority of people lack a proprietary edge in trading and tend to underperform compared to the broader market. Instead, people should invest in assets they understand and trust. Companies should also focus on a specific area of expertise. For example, a theme park company should stay focused on theme parks, a movie company on films, and an oil company on energy. This level of specialization allows investors to build portfolios with confidence, knowing what they are investing in. Take the example of MicroStrategy. If the company's strategy is to be long on Bitcoin with leveraged positions, that clarity helps investors make rational decisions. Those who dislike Bitcoin can choose to short the stock. Short selling isn't inherently bad because those positions eventually need to be covered. Alternatively, if someone believes Bitcoin has a 99% chance of failure, they might still allocate 1% of a $100 million portfolio to it and seek out a company that is purely committed to Bitcoin. Being transparent and predictable allows investors to allocate their funds logically. If a management team behaves predictably, an investor can confidently allocate a percentage of their portfolio after a brief discussion. However, If the management claims to have exceptional market timing skills, utilizing complex strategies and algorithms, investors may hesitate. Most of the time, these strategies fail. Investors prefer to hedge risks on their own terms, rather than relying on the management team to do it for them. In the end, unpredictability makes investing difficult, while transparency and a clear strategy make it much easier for rational investors to allocate their capital efficiently. When you meet someone who claims to have a complex and unconventional trading algorithm, instead of committing $5 million, you end up investing nothing and only spend $500 to study it. To put it another way, being predictable can allow you to raise $1 billion in just one day, even from people who are not Bitcoin enthusiasts. On the other hand, if you are unpredictable, you could spend 1,000 days raising nothing. The world seeks certainty, clarity, conviction, and focused execution. We believe in Bitcoin, but many people trade our stock regardless. For instance, someone could go long on our stock while shorting Bitcoin. This recent market crash is clarifying a lot of things. The crypto community is becoming more educated. Now, most people in the crypto space understand the difference between holding $1 in a bank and holding UST. They can likely discuss the distinctions between Circle and UST and how their business models work. Just last week, Tether managed to redeem billions of dollars, proving it had the necessary backing. In contrast, when people tried to redeem $7 billion of UST in a few days, they found it impossible. The industry has learned valuable lessons from this. Additionally, many institutions, like Caitlin Long's bank, are interested in issuing stablecoins. Banks such as Silvergate and Signature are FDIC insured, but cannot currently issue stablecoins. Major banks like JP Morgan, Goldman Sachs, and Citigroup face the same restrictions. 6 months ago, the President's Working Group issued a memo suggesting that FDIC-insured institutions should be responsible for issuing stablecoins. Regardless of personal opinions on this, regulatory gridlock in Congress has stalled progress. Future regulations are likely to disrupt the 990 and 500 existing cryptocurrencies, causing a shakeout in the industry. While such regulations are generally beneficial for Bitcoin, they pose challenges for other cryptocurrencies. Nevertheless, it is possible to create highly profitable crypto exchanges, stablecoin businesses, and crypto securities under a regulated framework. Achieving this will require significant effort. Most of the regulations being discussed in the Western world will likely accelerate Bitcoin's mainstream adoption. Bitcoin has the potential to grow 10-fold and then 100-fold. The primary obstacle is the lack of regulatory clarity in the crypto sector. For this reason, concerns about regulation do not trouble me.